Welcome to the deep dive. Today, we're going beyond
Okay.
the typical stock picking advice you usually hear and exploring special situations. Those kind of unique events like spin-offs, mergers, and yeah,
Hmm.
even bankruptcies where you can find hidden gems that are often overlooked
Yeah.
by the Wall Street giants. I've got an expert with me today to help us kind of navigate these often murky waters and show us how to challenge those
Absolutely.
efficient market assumptions everyone keeps talking about, ready to uncover some hidden value.
Absolutely. It is fascinating how these special situations
Yeah.
really expose the cracks in that efficient market theory. Big institutions have their hands tied. They can't just swoop in and buy up a tiny company, no matter
Right.
how undervalued it might be.
So it's like they're these giant ships that can't navigate those smaller inlets where the real treasures might be hidden.
Exactly.
Yeah.
And that's where the opportunity lies for individual investors like you.
Yeah.
You have the flexibility to explore those overlooked corners of the market.
Okay, I'm intrigued. Let's start with spin-offs.
Sure.
I know there's data showing they outperform the market,
Yeah.
but why is that? It seems counterintuitive that a company being split apart would suddenly become more valuable.
Well, you can think of it as a chance for both entities to kind of breathe and thrive
Okay.
on their own.
Hmm.
Often a company is holding back a hidden gem, a subsidiary that's just not getting the resources
Right.
or attention it deserves. And when that subsidiary spun off, it can finally focus on its core strengths
Oh.
and unlock its true potential.
Mm-hmm.
What's even more interesting is how institutional investors often react to this.
You mean they just dump these spin-offs without really understanding them?
It happens more often than you might think.
Really?
These large funds have mandates and restrictions,
Aye.
and a brand new spin-off might not fit their criteria.
Oh, interesting.
Plus, they're often judged on short-term performance, so they're not as incentivized to do the deep dives that these situations require.
So they're selling based on assumptions, not necessarily on the fundamentals of the newly independent company.
Oh, often. Yeah.
Okay.
Yeah?
That creates a buying opportunity, right? Especially since spin-offs don't happen overnight.
Exactly. You
Yeah.
usually have, 6 to 9 months to really get to know the company,
Wow.
analyze its financials,
Yeah.
understand its competitive landscape. That's a luxury most institutional investors don't have.
Okay, so you've got my attention. Can you give me a real-world example of a spin-off that surprised the market?
Remember Marriott International?
Oh, yeah.
Back in 1992, it was spun off from Host Marriott, which held all the real estate. Everyone thought Host Marriott, with its tangible assets, would be the star.
Right.
But it was Marriott International, freed from the burden of managing those properties that really took off.
So the company everyone thought would be the winner actually lagged behind? That's pretty counterintuitive.
Yeah.
Tangible assets don't always equal better performance, huh?
That's a key takeaway. Don't just assume a company's better off because it owns a bunch of buildings. Look deeper into what's driving the business, what its growth potential is. Sometimes, less is more.
That's a great point. I remember you mentioning another spin-off StratX Security from Briggs & Stratton. What made this one special?
Stratec made locks and keys for cars.
Okay.
And initially, based on the basic spin-off documents, it seemed fairly valued.
Right.
But I always dig deeper, especially into the Form 10.
Hold on, the Form 10, that sounds pretty technical. What is it and why should I care?
Think of it as the company's detailed autobiography. It lays out everything,
Okay.
from contracts and customers to future prospects.
Hmm.
And in Stratec's case, it revealed that Ford was expected to become their second largest customer. And that little detail
Wow.
wasn't widely known, but it had huge implications for their future growth.
Wait, so you uncovered this major growth driver just by reading through a regulatory filing?
That's the power of doing your homework. Most investors, even professionals, they rely on summaries and headlines. Right. But the real insights are often buried in those less glamorous documents.
So you're saying I could be a stock market genius if I just spend more time reading SEC filings?
Let's not get ahead of ourselves.
Okay.
It's not just about reading, it's about understanding the nuances
Yeah.
of the business, the industry, and the competitive landscape.
Right.
But having access to information that others overlook is definitely an advantage.
Okay, fair enough. Now let's shift gears from spin-offs to something equally intriguing, merger securities.
Go.
I know they can get pretty complex, so walk me through why I should even care about them.
Well, it's all about exploiting inefficiencies. Sometimes when companies merge, they use a mix of cash and other securities, bonds, preferred stock, even things called contingent value rights, or CVRs, to pay for the deal.
Right.
Institutional investors often aren't interested in these unusual securities.
So they just dump them, creating a potential bargain bin for the rest of us.
Exactly.
Yeah.
They might not fit neatly into their portfolios, or they might require more analysis than they're willing to do.
Right.
But for you, this could be a chance to scoop up undervalued assets that have been mispriced due to this institutional apathy.
I'm sensing a theme here. Take advantage of what the big guys are overlooking.
That's a big part of it.
Okay.
Let me give you an example. Remember the Paramount-Viacom merger back in 1994?
Yeah, vaguely.
Viacom used a complicated package of securities
Right.
to pay for the second half of the deal.
Okay.
Most investors were scratching their heads.
Yeah.
But I saw an opportunity, especially with the CVRs.
Okay, you got to explain these CVRs. They sound intimidating.
They're actually quite clever. They're designed to protect the seller's shareholders
Okay.
in case the buyer's stock price goes down. In the Paramount-Viacom deal, the CVRs basically guaranteed a minimum return for Paramount shareholders, even if Viacom stock tanked.
Hold on. So it's like built-in insurance against a bad outcome. Why wouldn't everyone want that?
That's the thing. The information was right there in the proxy statement.
Right.
But most people didn't understand it, or they were too intimidated to dig into the details. They saw complexity and ran the other way.
But you saw an opportunity that others missed just by taking the time to understand these unusual securities? That's incredible. I'm starting to see why special situations can be so rewarding.
It can be, yeah.
Yeah.
But remember, it's not about blindly chasing every deal or spinoff. You have to be willing to do your homework to understand the businesses involved
Right.
and to assess the risks and rewards.
So we've covered spinoffs and merger securities. Now let's talk about the elephant in the room, bankruptcies. I know a lot of investors get scared off by this one. What's your take?
Bankruptcies can be scary, I'll give you that.
Yeah.
But remember, a bankruptcy doesn't always mean the company is going out of business.
Right.
Often, it's a chance for a fresh start, a way to restructure debt and emerge stronger on the other side.
So it's like a phoenix rising from the ashes. But how do we even begin to evaluate a company in bankruptcy?
That's where the disclosure statement comes in. It's filed with the bankruptcy court and outlines the company's plan for reorganization, including management's projections for the future.
Okay.
It's a goldmine of information, and it's publicly available.
So instead of panicking and running for the hills, we should be reading these disclosure statements and looking for signs of a potential comeback.
Yeah.
Interesting. I'm guessing there are a lot of anxious sellers in these situations, which could create some real bargains.
You're catching on. When a company files for bankruptcy, fear takes over. People see the word bankruptcy, and they automatically assume the worst.
Right.
But for those of us willing to look past the headlines and dig into the details,
Yeah.
there can be incredible opportunities.
This is all starting to make sense. Special situations are about finding value where others are too afraid or too busy to look.
That's right.
I'm excited to dive deeper.
I'm glad to hear it.
Yeah.
Remember, these situations often involve complexity and uncertainty,
Right.
but that's where the real potential lies.
I'm ready for the challenge. Let's take a closer look at a real-life bankruptcy situation where you spotted an opportunity.
Okay, let me tell you about Charter Medical, a company that operated psychiatric hospitals.
Yeah, they ran psychiatric hospitals.
Okay, psychiatric hospitals, that's not exactly an industry that screams, hot stock tip.
Right.
What made you even consider
Right.
looking at Charter Medical?
It's all about digging beneath the surface, right?
Yeah.
Charter emerged from bankruptcy in 1992, and everyone was running scared.
Right.
But when I compared Charter to other, similar companies,
Okay.
something interesting popped up. Their earnings were solid, the management team was experienced, and the stock price, well, let's just say the market was giving them a serious bankruptcy discount.
So you saw through the stigma and recognized the underlying value. But let's be honest, wasn't there a ton of risk involved? I mean, the company
Yeah.
had just gone through bankruptcy.
This brings up a crucial point. How do we actually define risk?
Yeah, that's a good question. The typical measure, beta, just looks at a stock's volatility.
Right.
But that doesn't tell the whole story, especially in special situations.
So a stock bouncing all over the chart doesn't necessarily mean it's risky, and a seemingly stable stock could be hiding some serious problems. I'm starting to see why the standard Wall Street playbook doesn't always apply here.
Exactly. The real risk is permanently losing your capital.
Right.
And the best way to mitigate that isn't by obsessing over daily price fluctuations, but by investing in companies that are truly undervalued, companies with strong fundamentals and a path to growth.
Okay, that makes sense. But even with a company like Charter Medical, where you saw those positive signs, you still had to have some faith that they would turn things around.
Of
Okay.
course, there's always some degree of uncertainty.
Yeah.
But the potential upside was significant,
Right.
and the price was incredibly attractive.
Right.
It was a calculated risk, not just a random gamble.
Calculated risk. That's a good
Yeah,
way to put it. So, how did the Charter Medical investment play out? Did they actually manage to pull off a comeback?
they did. Their earnings continued to improve,
Right.
and the stock price eventually reflected that. It wasn't a smooth ride, but that's often the nature of special situations. It's not for the faint of heart.
Okay, that brings up another important question. How do you know when to sell? These special situations often have a limited time frame, so timing seems pretty crucial.
Here's a simple rule I've always followed. Trade the bad ones, invest in the good ones.
Okay, I like that. But what does it actually mean in practice?
If you buy a mediocre company simply because it's cheap,
Why?
be ready to sell when the market catches on and the price goes up. But if you find a truly great company, one with a competitive advantage, strong management, and a solid track record,
Hmm.
you can afford to hold on to it longer.
So it's about recognizing the difference between a temporary mispricing and a long-term opportunity. How did that apply to Charter Medical?
Well, Charter was a good company,
Okay.
but the psychiatric hospital industry was facing some serious headwinds.
Right.
So while their earnings were improving, I ultimately decided to sell the stock after a nice profit.
Okay.
It was a successful trade, but I didn't see it as a long-term hold.
So you were disciplined. You didn't get emotionally attached to the company just because you had uncovered this hidden gem.
That's a key part of being a successful special situations investor.
Yeah.
You have to be able to detach yourself from the story and focus on the facts.
Okay, so now I'm really curious. How do I find these opportunities? It's not like there's a special section on Yahoo Finance for special situations.
You're right, they don't make it easy,
Right.
but it all starts with one simple word, reading.
Reading. Seriously. Not some fancy algorithm or insider tip.
It might sound old-fashioned, but trust me,
Uh-huh.
it works.
Okay.
The Wall Street Journal is your best friend here. They cover a wide range of companies and transactions, often in great detail,
Right.
but you have to go beyond the headlines.
Okay.
The real gems are often buried deep within those pages.
So I need to become a financial detective, combing through the news for clues.
Exactly. And don't overlook local and regional newspapers.
Okay.
They often provide more in-depth coverage of smaller companies that might be flying under the radar.
Expanding my reading list. Check.
Right.
What about newsletters? Any recommendations for those of us who want a more curated approach?
Outstanding Investor Digest is excellent.
Okay.
They feature interviews with top value investors who often discuss their special situation ideas. And you can learn a lot by reading the prospectuses of the Franklin Mutual Series funds.
Okay.
Michael Price, who runs those funds, is a legend in the special situations world.
Right.
You can learn a lot from him.
So you're saying I can steal ideas from some of the best investors in the game just by reading their public filings. That's
Oh.
brilliant.
It's not stealing,
Okay.
it's learning.
Okay, learning.
And of course, you can't forget about SEC filings. Those are the motherlode of information.
I knew you were going to say that. But honestly, SEC filings can be so intimidating. They're like written in a foreign language. Any tips for navigating that maze?
For spinoffs, the Form 10, as we discussed,
Right.
is
Yep.
essential.
Okay.
And for going private transactions or stock buybacks, dive into Schedules 13E3 and 13E4.
Okay.
They're packed with valuable insights.
Okay, so I've got my reading list and my SEC filing decoder ring. I'm ready to start hunting for those special situation bargains. But how do I know if something is truly undervalued? The usual valuation metrics don't always seem to apply in these situations.
You're right.
Yeah.
Those traditional metrics can be misleading when a company is going through a major transformation.
Right.
You have to look beyond the PE ratios and dig into the underlying assets, the cash flow, and the potential for future growth.
So it's more about understanding the story, the potential of the business, rather than just crunching numbers.
Exactly.
Yeah.
Valuation is as much art as it is science. There's no magic formula.
Yeah.
You have to gather all the information you can, weigh the risks and rewards,
Yeah.
and make a judgment call based on your own analysis.
So I'm basically becoming a financial detective, piecing together the evidence to build a case for investment.
I like that analogy.
Yeah.
And remember, even the best analysis can't predict the future with 100% certainty.
Right.
There's always an element of risk.
So I'm embracing the uncertainty, knowing that I can't control everything, but I can control how much research I do and how I approach the decision-making process. Any other words of wisdom before we move on?
Just remember to be patient.
Okay.
Special situations often take time to play out. It's not about getting rich quick. It's about understanding the long-term value that can be created through these unique events.
So we're playing the long game, not chasing after every fleeting opportunity. I can handle that. Now let's talk about some of the common pitfalls that special situations investors should avoid. What mistakes have you seen people make in this space?
One of the biggest is getting caught up in the short-term noise.
Right.
Remember, these situations can take months, even years to unfold.
Right.
Don't get discouraged if the stock doesn't skyrocket overnight.
So we're tuning out the noise and focusing on the long-term potential of the business. Makes sense. What else should we watch out for?
Another common trap is getting too emotionally attached to an investment. It's easy to get caught up in the story, the excitement of finding this hidden gem.
Yeah.
But remember, special situations are often about capitalizing on temporary mispricings or market inefficiencies.
Okay.
It's not about falling in love with a company.
So we're keeping our emotions in check, making decisions based on logic and analysis, not sentiment or attachment. It's like we're training our minds to think differently about investing.
Exactly. And remember, even the best investments eventually run their course. You need to have an exit strategy to know when to sell and move on to the next opportunity. Don't get stuck holding on to something just because you have a good story about how you found it.
So we're constantly reassessing our positions and making adjustments as needed. We're not afraid to take profits or cut our losses when it makes sense. What else should we keep in mind?
One of the most common and most costly mistakes is simply not doing enough research.
Oh, yeah.
Special situations require a deeper level of analysis, going beyond the headlines and diving into the details of the transaction or event.
Right.
Don't cut corners here.
So we're rolling up our sleeves, reading those SEC filings, and becoming experts on the companies and situations we're investing in. No shortcuts allowed.
Exactly. Knowledge is power.
Yeah.
The more you understand about the special situation,
Right.
the better equipped you'll be to make informed decisions and capitalize on the opportunity.
This has been incredibly insightful. I'm starting to see the world of investing in a whole new light. It's not just about picking stocks, it's about understanding these unique situations where real value can be unlocked. Now, I know we've covered a lot of ground, from spin-offs to bankruptcies, from valuation to risk management, but I want to circle back to the human element of this approach. Special situations investing can seem complex and even a bit intimidating,
Yes.
especially for those who are new to this world.
You're right, it can be daunting. Yeah. That's why it's so important to find a community, to connect with other like-minded investors who are also exploring this space. There are online forums, investment clubs, even mentorship programs that can provide support and guidance.
So we're not going it alone. We're building a network of fellow special situations enthusiasts to share ideas, ask questions, and learn from each other's experiences.
Right.
I like that. It takes some of the pressure off.
Exactly. Investing doesn't have to be a solitary pursuit. Collaboration and shared learning can make the process more enjoyable and ultimately more rewarding.
Right.
And remember, you don't need to be a Wall Street wizard to succeed in this space.
That's encouraging. So what does it take to be a successful special situations investor?
It's about being curious, persistent, and willing to learn and adapt.
Okay.
You have to be comfortable with complexity, uncertainty,
Right.
and the fact that there's no guaranteed outcome. But that's also what makes it so exciting.
So we're embracing the challenge, the unknown, the potential for both great success and, let's be honest, the occasional setback. It's all part of the journey.
Well said. And remember, the stock market is constantly changing.
Right.
New special situations are emerging all the time.
Right.
What worked yesterday might not work tomorrow.
So we're staying flexible, adaptable, and always on the lookout for new opportunities. It's like we're constantly evolving our approach, our thinking, our understanding of how the market really works.
That's the mindset of a true special situations investor. It's about being a lifelong learner, a constant student of the market,
Yeah.
and someone who's always willing to challenge conventional wisdom.
It sounds like special situations investing is as much about mindset as it is about analysis. You have to be willing to think differently, to go against the herd, and to embrace the unknown.
That's a great way to put it. Yeah, it's not for everyone, but for those who thrive on challenge and intellectual curiosity, it can be an incredibly rewarding approach.
Yeah.
And remember, every special situation is unique. There's no one-size-fits-all formula.
So we're constantly adapting, learning from our experiences, and refining our approach. It's a continuous process of discovery and improvement, kind of like we're explorers, charting new territories in the financial world.
I like that analogy.
Yeah.
And remember, the most important thing is to enjoy the process. Special situations investing can be intellectually stimulating, financially rewarding, and even a bit addictive once you start seeing those opportunities that others are missing.
Yeah, it's like we've unlocked a secret level in the game of investing. I have to admit, I'm feeling pretty inspired to start digging into some of these special situations myself. Where do you recommend I begin? Any parting advice for our listeners who are eager to dive in?
First, don't feel like you need to become an expert overnight. Start by focusing on one type of special situation,
Right.
spin-offs, for example, and really get to know the ins and outs. Read everything you can find, follow the news, and maybe even join an online forum or investment club to connect with others who are also exploring this space.
So start small, focus on one area, and gradually expand your knowledge and experience. That seems manageable. Any other tips to keep in mind as we embark on this special situations journey?
Remember to be patient. These situations often take time to unfold. Don't get discouraged if you don't see immediate results. Stay focused on the long-term potential, not the short-term fluctuations.
So we're in it for the marathon, not the sprint. Got it.
What about risk management? Any advice for those of us who might be a little hesitant to dive into these unconventional investments?
Diversification is key. Don't put all your eggs in one basket, even if you think you've found the most undervalued opportunity in the world. Spread your bets across different special situations and make sure you have a solid foundation of more traditional investments in your portfolio. And remember, you don't have to go it alone. Talk to experienced investors, seek out mentors, and never be afraid to ask questions. That's great advice. Build a network, learn from others, and don't be afraid to make mistakes along the way. It's all part of the learning process. This has been an incredible deep dive. I feel like I've gained a whole new perspective on the stock market and the opportunities that are out there for those who are willing to look beyond the obvious. Thank you for sharing your expertise and insights with us.
It's been my pleasure. I'm always excited to talk about special situations and to encourage more investors to explore this fascinating corner of the market. Remember, knowledge is power, and the more you learn, the better equipped you'll be to succeed.
That's a great takeaway. So, to all our listeners out there, keep learning, keep exploring, and most importantly, keep diving deep. This is just the beginning of a journey to becoming a smarter, more informed, and more successful investor. Until next time, happy investing.